What's up, everybody? This is Jeremy Ritz of Courage Pays Better Than Fear, welcoming you to episode number 44 of the Traders Podcast. So grateful to be with you here today. And we're going to be talking about market crashes and what causes market crashes, how to deal with and navigate market crashes. And something that most people don't understand is that true wealth is ultimately built following a bear market. And so we're going to get into that and more here, episode number 44 of the Traders Podcast. All right, guys, thank you so much for being here with me for episode number 44. And it's been a bit of a sell-off since December 18th in the broader markets. And let's face it, 3, 2, 1. So I'm super appreciative that you're here with me today for episode number 44. And I'm grateful that you were here last week when I had Justin Maxwell on the show. But today we're going to talk about market crashes because they are a significant part of financial history. And they follow bull markets. And because we've had quite a bit of selling since December 18th after the Fed cut rates and then approach things with a hawkish tone in Jerome Powell's press conference, I just wanted to spend some time talking about this concept that can be incredibly unnerving. And whether it's the 2008 financial crisis, the dot-com bubble of 2000, or the COVID crash in 2020, all saw super deep declines. These events can cause panic, fear, anxiety, frustration, and even the most seasoned traders and investors. But why do these crashes happen, and what can we learn from them? Well, one of the first reasons is herd mentality. And so when everybody is doing something, there's a contagion factor. And so what we could look at just recently here, if you go back to August of 2024, there was a brief period of time, and this was actually on August 5th, where we saw a significant drop. But there was an uptick in the unemployment rate. And the masses responded to that by saying, oh no, the sky's falling, we're headed into a recession. And what happened at that point is you saw a massive sell-off in equities. And everybody was afraid that, oh, here comes the recession that we were worried about. And so what happens is that contagion factor comes alive to where people start selling, and then the media presents panic. Oh, the market's going to keep coming down. It's overvalued. Bearish, bearish, bearish. And then what happens? People get afraid and they sell, and that drives it down. And so that contagion factor is critical. It's a critical component of big market declines, market crashes. And if you think back to 2008, I was a young man at the time in my 20s, teaching high school English in Maryland. But there were many people who were buying into the housing market. I know I did at that point. I bought a home that was $308,000, and then right after, the housing bubble popped and my home was underwater. But everybody was buying because that's what everybody was doing. It's that herd mentality. Once again, the media, the banks, and even the government were all telling us about the good times and how they'd never end. But once that housing bubble burst, panic set in, and millions of investors sold their positions in fear of losing everything. So that housing crash really triggered a sell-off in the markets. Again, that herd mentality. And psychologically speaking, people, 3, 2, 1. And from a psychological perspective, people are wired, we are wired as human beings to avoid loss more than we're motivated by potential gains. That risk is really scary for many of us. I know even for me, it can be uncomfortable. But that fear of loss is amplified, it's intensified during market crashes, and it creates a loop where that panic triggers further selling, which then causes more panic. And you're wondering, where does it stop? Are we just coming to zero? So that herd mentality is a big component of the psychology of a market crash. Now, let's take a look at the patterns of market crashes. And if we go back through history, we can identify certain elements that recurred that preceded a crash. And again, if we go back and look at that dot-com bubble and crash and the 2008 financial crisis, we talked about the housing market popping. The markets were incredibly overbought, overheated. They were just run to the top without any relief. And so if we look at that tech bubble of the late 90s, that was all driven by speculation, with many investors just betting on companies that had no profit, just big ideas. So think about that. You're putting your money into a company that you feel is going to move higher, but there's no substance or nothing really tangible to say that they are going to be successful. And then if you go to 2007, 2008, with that housing crisis, we saw a similar pattern. The housing market was overinflated. Everybody was buying, thinking that prices would only go up. I talked to you about the home that I purchased in 2008. It just happened to be that year. Lucky me. And in both cases, that bubble that just kept expanding and expanding, it burst, causing that market to fall pretty quickly, causing panic and chaos. And one thing that is common across all of these events is the role of leverage. And what we mean by leverage is borrowed money. And we talk about the dot-com boom. Many investors borrowed heavily to buy stocks. So leverage is where you're borrowing money to purchase stocks, and you could get into significant trouble there. And during that housing boom, banks were lending to people who couldn't afford to repay. And so when things tanked, you can imagine what happened. It caused some severe losses. And then another component of this is just euphoria. And this is typically a signal of a market top where everybody believes, man, this thing can't come down. It's just going to keep running. It's going to keep going higher and higher and higher. And when that happens, people are just buying in again without looking at the charts, without understanding that the markets are overheated. And that euphoria causes a bubble. Go look at the COVID crash of 2020. Things were on such a spike, such a move higher. And then all it took was a global issue. Now, granted, COVID was pretty significant and it caused a massive sell-off. And we're going to take a look at those on the charts here in a few minutes. So euphoria typically is something that's associated with market tops and subsequent crashes. And how about the timing of market crashes? And that's something that's interesting because they could be rather quick and sharp. If you go and look at COVID, like I said, we'll look at that here in a few moments. It was a fast drop. Things fell very quickly, but then there was a quick recovery, quick relief from that. If you look at the flash crash of August 2004, which wasn't even 10%, it was just below 10%. It had dropped hard and then immediately was bought back up. So crashes can be pretty quick and there can be fast recoveries. However, if you look at some of the more prolonged incidents of market crashes in the past, if you look at 2008, the housing crisis, if you go back to 2000, the dot-com bubble, those took time for recovery. But here's the thing, and I've said this several times on the podcast before, is that the markets were designed to do one thing, and that's to go up over time. So those moments of panic where people were selling everything and taking massive losses, it was to their misfortune, to their future self, because eventually they recovered. Now, in some cases, it took longer than others, but the market is designed to go up over time. And so you might be asking yourself, well, how do we predict when the next market crash is going to come? And if you are on Twitter, also known as X, well, it is known as X now, you can see that there are tons of bears out there calling for the end of the world in the stock market, that we're going to get a crash equivalent to what we saw in 1929 in the Great Depression. But here's what I tell you. You can't predict a market crash. It's going to come out of nowhere when you least expect it. And so it's not about prediction, it's about preparation. So in the event that a crash does happen, you're hedged, you're protected, and you have enough cash on the sidelines to go long when the market bottoms out. And first and foremost, you need to have a risk management plan. And that means understanding how much you're willing to lose on any given trade. We talk about that a lot through courage trading, protecting yourself with that stop loss, not trading beyond what you're willing to lose. And a lot of traders don't realize this, but one of the easiest ways to prepare for a crash is using stop loss orders. And I can't emphasize that enough. Stick with your stop loss. And I've done this before when I first started trading, where I've taken my stop loss out, saying to myself, oh, this is going to recover. but that has only resulted in major losses. So make sure you have those stop losses in place. And they're essentially safety nets that automatically sell your position if the price drops below a certain level. And they can save you from a lot of panic and anxiety if there is, in fact, a crash. And the other thing you could do is just diversify what your long-term positions are in. So you don't want to be all in one sector. You don't want to all be in technology. You don't want to be completely in energy. You don't want to be fully in healthcare. You want to have a diversification in your long-term portfolio of what you're invested in or what you're trading long-term, because you'll have a much better chance to make it through downturns like this in a successful way. I also mentioned having cash on the sidelines so that if there is a significant drop and things bottom out, you're ready to go along. And that references the Warren Buffett quote that I absolutely love. And that is, be fearful when others are greedy and be greedy when others are fearful. And like we're going to look at in the charts here in a few moments, had you have bought at the bottom of some of these bear markets, some of these crashes, the profits that you would have enjoyed would have been astronomical. So we'll take a look at that. And then finally, the emotional component of a market crash. It could be uncomfortable. It could be scary. It could be frightening, but that's where your plan comes into place. If you don't have a plan in place that clearly specifies what it is that you're going to do in these types of situations, then it's going to cause a lot of uncertainty, fear, because you don't know what your response should be. So have that plan in place so that when a crash does occur, because it's not a matter of if, it's just a matter of when, you're prepared and you know how to attack it. And so what I wanted to do is just give you an example of some of the crashes that occurred in the past. And what I have drawn out here on my screen is how one particular trader sees things playing out over the next year, 2025 into 2026. But we're not worried about that. We're not looking at it. We want to go into the past and see when these crashes have happened. All right. And so this first one, this is August of last year, 2024. We could see that the markets were up near all-time highs, but then we had a significant drawdown over 3 days that equaled to, let's see, that was 448 points. But you could see after this crash, what happened? Buyer stepped in and this thing pushed back up before retesting and then making new all-time highs. So this was a little short-lived crash, but it was scary. There was panic in the air. Let's go back to this is the bear market of 2022. And I wouldn't necessarily call this a crash, but you could see here the market peaked out in January of 2022, a little over 4,800. And then you could see what happened after this. Stocks dropped 27.64%. All right. So that was a scary moment for anybody who was invested in the market, who's a trader, an investor, because that is quite the drop in value. And when you look at this, you know, the thinking is, oh, this is going to keep going down. It's going to keep going down. But imagine had you bought right here, and this, we're looking at the S&P 500. This reflects the broader markets. Look at the gains that you could have potentially made. All right. And you're going to see this repeat over and over as we look at these crashes. So we talked about COVID, right? Here's COVID 2020. We peaked. And then look at this drop from, what's the date here? February 19th, 2020 to, what is this? This was March 23rd. We all remember COVID. That was crazy. Seems like it wasn't even real. But the market dropped 35% and everybody was panicking. It's the end of the world. Oh my gosh. But imagine had you bought here, look at this run up that you would have had. Look at that, right? So fear is not the best indicator to tell you when you should sell a stock. This is not a good idea because look at the run up that you would have made. And had you held through that mini bear market that we had and you held to current day, you would be crushing it. All right. So let's just go back. Let's go look at 2008. All right. And here's 2008. Now, this was a more sustained drop. When we looked at the 2020 crash, it was short-lived. But this one, if we measure this out, we made the highs here October 11, 2007. And then from the height to the bottom, this is 515 days. And the market gave up 57% of its value. Now, that's almost 2 years. And you could see how long it took for this thing to recover. And let's measure that out here using this ruler. But it took almost 1,500 days in order for it to make new all-time highs after it bottomed. So this was a more prolonged financial crisis, and this was the housing the housing bubble that burst. But again, the same thing. Had you been a buyer here when this hit lows, you would have made a lot of money, right? So just it really illustrates that quote from Warren Buffett. And then we're going to take a look at the 2000.com bubble. A lot of people are comparing what we're seeing today to 2000, and let's just measure out here what we have. So we hit a high, and then this thing bottomed right here. So October 8th, 2002. So this was 929 days. This dropped pretty significant, and it gave up half of its gain. So this was a significant drawdown. But the same thing, and this is what I'm trying to get through here, is that it did eventually recover. Now, we do see that this led into 2008 where we got another drop. But just keep this in mind. Markets always recover. The duration of these crashes, these pullbacks, it's all going to be different. But if you're prepared, if you have a plan, if you have cash on the sidelines, if you don't react emotionally, if you do all those things, you'll be in a position to ride out these drawdowns. And if you have that cash on the sidelines and you have a good idea of where that bottom's coming in, you can make a hell of a lot of money. And so that's going to do it for episode number 44 of the Traders Podcast. Hopefully you're leaving today with a better understanding of market crashes, how they work, how to anticipate them. Remember, we can't predict them. It's just a matter of when they're going to occur. And let me know your thoughts. Do you think a crash is coming here in 2025 or maybe next year, 2026? Let me know in the comments. I appreciate your support. Please like and subscribe to this channel, share with your family and friends, and I'll see you back here next week for episode number 45, a brand new episode of the Traders Podcast. Have a great day, everyone.